Hello everyone, welcome to the stream. So today we're going to be talking about Warren Buffett, specifically Warren Buffett in his younger years. Now, a lot of you guys might not know that Warren Buffett actually made his biggest, most lucrative investments earlier in his career. In the 1950s, 1960s, Warren Buffett was making 30, 40, 50% returns each year. And it's very different, actually, from the Warren Buffett that we know now. And that's because when you have hundreds of billions of dollars to invest, you can't achieve the same returns that you did when you had a less amount of money, say $10 million. And that's because you can't invest in a lot of those big companies, or you can't invest in those smaller companies or medium-sized companies, because if you invest in them and you have hundreds of billions of dollars, those companies are going to be a negligible impact on your total return. So I think learning about Warren Buffett's earlier years is very applicable for the average retail investor, because we don't have billions of dollars. And I think it's very helpful learning from Warren Buffett during this period how he wanted to manage his money, because I think it's actually more instructive to learn about how he manages money earlier in his career than maybe later. So let's get into the presentation here. Give me 1 second. Alright, so during this time, Warren Buffett achieved a staggering return. So the Dow Jones Industrial Average from 1957 to 1969 achieved about a 9.1% return, while Warren Buffett during that same time achieved an annualized return of 31.6%. That's crazy. It basically means that if you invested with Warren Buffett in 1957 and you invested $50,000, 12 years later in 1969, you would have become a millionaire with $1.35 million. That is absolutely staggering. It's a really great performance for sure. So, one thing that not a lot of people might know is that during this period from 1956 or 57 to 69, when Warren Buffett was managing his company, Buffett Partnerships Limited, and this was when he was going out and managing other people's money. It was before he started Berkshire Hathaway. He wrote letters very regularly to his partners, or the people who invested in his fund. And in these letters, he lays out his investment philosophy, different strategies for how he invests, as well as he even goes into some pretty significant detail about some of the companies that he invested in during this period, how much he paid for it, how much he ended up making, and his rationale for making these investments. So this is what I'm going to be covering today, and I think it's useful for all of you guys just to understand exactly how Warren Buffett was investing and what his thought process was during this early stage in his career. All right, so Warren Buffett, first of all, shares a lot of philosophies during these letters. And what I'm going to do first, I'm going to go into some of Warren Buffett's thoughts on investing. Then I'm going to go into his investing strategies. And the later part of this presentation, we're going to be covering some examples of Warren Buffett's investments. So Warren Buffett puts a lot of thought and kind of philosophizes why regular investment managers don't make very significant or very staggering returns most of the times. And in these letters, he often benchmarks the Dow Jones performance, which was the top 30 companies at the time. So basically, it's similar to the S&P 500 that we have now. It's a tracker to show the general performance of the stock market. So what Warren Buffett was doing is he was benchmarking the performance of the Dow Jones Industrial Average with the performance of regular investment managers at the time. And he found out that very few of them consistently could outperform the market or outperform the Dow Jones Industrial Average. And he kind of gives a few reasons behind this. And the first is because of a really bad incentive structure. Now, investment managers what they do is, at the time, they would, let's just say you're managing $10 million. The investment manager each year would be charging their clients 2% out of that $10 million each year. So it creates an incentive where the investment manager, to make more money, actually wants to increase the amount of money that he or she is investing rather than increasing the total return. Because if you make 10%, 12%, 8%, it might not make a significant difference to how much you're paid versus if you got another maybe 50 people to give you an extra $10 million each. That would certainly fatten your pockets a lot more than trying to chase that extra 1 to 2% return. And it might not even be worth it for you to chase that extra 1 or 2% return because it might create the risk of your fund having a bad year. And that might cause a lot more of your investors to try to take their money out and move it elsewhere. So the main problem behind investment managers managing money is that it didn't make sense for them to take too many risks out of the box in order to achieve great returns. What these investment managers would actually do is they would follow a strategy that's similar to Noah's Ark. Now, if I remember my Sunday school lessons, Noah's Ark was a situation where God was going to go and destroy the earth. And then he told Noah, you got to go and fetch 2 species of every single animal or insect or whatever and just take them into the ark. And what Warren Buffett says is that at the time, a lot of investment managers followed the Noah's Ark strategy for investing. They would go and look at every single geography, every single industry, and they would try to pick out a few companies in each geography and each industry. So their overall portfolio, they would be investing in hundreds and hundreds of different companies. And Warren Buffett thinks that this is a very bad way to allocate capital, because what he finds out is that, him being a very smart guy, each year he could only find maybe a handful of investments that he thinks have a good chance of outperforming the market. And there aren't many of these ideas each year. So there's no way that you can have hundreds of companies each year outperform the market. So what you do by taking all that money and putting it into, say, hundreds of different companies is you are almost guaranteed to have mediocre performance. Because in those 100 companies, say, or 200 companies, you're going to have some companies that are going to be doing really well in that year. You have some companies that maybe won't do so well. Most of them are probably going to do somewhere in between. So the returns are all going to cancel each other out, which means that your overall performance is probably going to be very similar to the overall performance of the market, maybe if not a little bit lower once the fees are deducted. So that's a big problem. And a very funny analogy that Warren Buffett said is, if you're an emperor and you have a harem of, let's just say, 75 girls, you're not going to know any of them very well. And applied to investing, it's very similar. It's like if you have a portfolio of hundreds of different companies, you're not going to understand any of them very well either, which makes your chances of achieving great returns to be pretty low. Now, the question is, why did so many companies choose to go down that path, to go and spend, to try to buy so many companies, like hundreds of companies? And why do none of them really try to take the risk to get higher returns? Well, it all comes down to following the herd. Because at the time, and even still today this applies, a lot of the top investing companies out there, they go and they're successful by investing a lot of money. They're successful by growing the number of rich people who give them money to invest, and they go by doing a pretty low return strategy, but because they invest in so many companies, the movements of their portfolio tend to be pretty consistent with the overall market. And everybody else is looking towards these really big investment companies, and they're saying, oh, we need to be more like them. So they try to copy exactly what they're doing, and that kind of creates a culture of mediocrity within the investment management world, is everybody is trying to essentially do the same thing. And Warren Buffett kind of draws a very interesting example where there's people always constantly asking him why he's not investing in the blue chip companies at the time. So the blue chip companies were like the big well-known companies in like the 1950s, 60s, kind of like what Google and Microsoft are today. So like Kodak or IBM, why is he not investing in these companies? And Buffett is saying, like, the way to succeed in investment management is not to follow the herd. If the herd, which are the big investment companies and everybody else, if they're going and buying these big companies, then these companies are going to get really expensive. So then if I go and invest in them, it's risky, because these companies are so overvalued that at some point there's going to be a correction. The price is going to go down because it can't possibly be justified that these companies are actually worth that much just because everyone else is piling in. And he was mentioning that to succeed as an investment manager, you have to do something that's different from what everything else is doing. And just because a lot of people agree with you and are doing the same thing as you are, it doesn't mean that you're actually right. So overall, these are the reasons that he's giving for why existing investment management companies are not able to really perform very well. And Warren Buffett, and how he runs his fund, when you read through these letters, it's very clear that he tries to do exactly the opposite of what a lot of these companies do. So if we go and we review how this works, Warren Buffett deliberately designed his fund in a way that was completely the opposite of how the incentives work here. Instead of taking a proportion of how much money he was being given to invest, Warren Buffett instead created an incentive structure where the higher the returns he made, the better the partners did. And if he didn't make good returns, then he was also on the hook for the money that was lost. So that's something that's really, really interesting. And another thing is, these investment managers, because they want to make the most investment fees, which is a percentage of the total amount of money that they manage, they would try to continually grow the amount of capital that they're managing. While Buffett, on the other hand, once his fund reached a certain size, he didn't want to continue to get more capital because he wasn't sure that the increased amount of capital was going to be good for him in making investment returns, because the bigger the size of money that you have, the harder it is to generate returns, because it makes it difficult to invest in smaller or medium-sized companies. And that was the bread and butter of what Warren Buffett was doing at the time. So after creating an incentive structure, Buffett had the exact opposite approach to a lot of these big investment companies. Rather than trying to go and take his money and splurge it on 200 different companies, Warren Buffett at times would allocate up to a 40% allocation into just one stock. And the way he thought about it was, if I have a really good idea that I think is very likely to outperform the market and has very low downside, I'm going to allocate pretty much most of my money into that one opportunity, rather than splitting up my money into my second, third, fourth, or fifth best idea. So there was a lot of concentration in Warren Buffett's strategy. And the next thing is, Warren Buffett certainly did not follow the herd. The opportunities that he was looking at, which we're going to go over later, are not the companies that typically draw the attention of a bunch of other investors or other investment management firms. In fact, Warren Buffett would try very hard to make it so that people didn't know what he was investing in. Oftentimes, when he would take controlling positions of a lot of these companies, he would make it so that people don't actually know about the companies that he's actually investing in, so he can continue to accumulate a lot of these shares at low prices. Okay, so let's keep going. Another aspect of Warren Buffett's philosophy, which he goes over in a lot of these shareholder letters, is the idea of staying within your circle of competence. So, a circle of competence is basically what you understand to be true. And there are two different areas that Warren Buffett chooses to stay out of. One is timing short-term movements of stocks. And Warren Buffett talks about in this one part of the letter where there's shareholders or partners asking him, hey, given the fact that the stock market just went up by a lot, why didn't you buy more of that stock? Or when the market goes down, they're saying, why didn't you sell this stock before the market went down? And Warren Buffett in his response basically says, the short-term price movements of stocks and predicting price charts is pretty much the same thing as astrology. And if we base our investment decisions and strategy based on astrology, then we're probably going to go bankrupt. Something to that regard. So, very important in staying within your circle of competence or staying within what you believe to be true is avoiding any kind of predictions around short-term price movements. Another thing is staying away from companies that Buffett wasn't really sure of understanding very well. So one of the things that Buffett chooses when he invests in a company is either you have very stable and preferably growing earnings, or your asset values are going to continue to retain their value and you're able to grow the value of your assets over time. If Buffett has the thought process that he isn't sure that the assets of the company are going to be more valuable 10 years from now, and if he's not sure that earnings are going to be stable and will grow in the future, then he stays away from these kinds of businesses. And shareholders have even asked him about whether or not he would venture into the semiconductor space or the emerging technology space. At the time in the 50s and 60s, these were like big investment opportunities, and Buffett stayed away from them, and he preferred to focus on manufacturing companies or banks or insurance companies where he understood their businesses, and he avoided those big juicy, flashy tech names even in the 50s and 60s. Another very important aspect of Buffett's philosophy, which he goes over, is how to evaluate your performance. And here we see a picture of some very cute ducks. And the analogy that he gives is if a tide comes and it's a very high tide, a duck on that tide will rise with the tide. And it might seem like people looking at that duck being, wow, that duck is really high up, when really all the duck is doing is just riding the tide. And once the tide goes down, a lot of these ducks will go down with the tide. And only a few of these ducks are actually going to be able to flap their wings and stay above the water. Now, very poetic example, what does this mean? Well, in this case, the allegory is using the tide to signify the performance of the market. Where if the overall stock market or Dow Jones Industrial Average or S&P, if we're talking nowadays, if the stock market does really well, and you're also doing really well, we don't know whether or not your performance is actually due to just people being overly jubilant or if you're actually a skilled investor. But when the tide goes down, or when the stock market goes down and the overall sentiment goes down, if you're still doing well as an investor, it means you're pretty darn good at investing. While a lot of people who seem like they were doing really well while the tide was high, the minute the sentiments change, if they start doing badly, that's most people. So, Buffett, because he invested in companies that were not very conventional, and he stayed away from a lot of these blue chip companies or the Kodaks and the IBMs, basically what they were the Microsofts and Amazons of today. Because he stayed away from that, he wrote to his partners that in times when the stock market is super jubilant, he doesn't expect his fund to perform as well. At best, he might be able to match the performance because a lot of money often goes into these blue chip companies or these very well known names during very good times when investors are jubilant. He will find it hard to match the performance of those companies. However, he believes that his fund will show its strongest, the best years when the Dow Jones or the overall stock market is down, because he believes that he can keep his fund to drop less than the overall market during bad times. And the reason behind this is because he believes that he invests in really good, high quality companies for a very low price, and the price is so cheap that it probably won't be able to drop all that much, even once the stock market goes down. And of course, he has other strategies for dealing with market downturns, which we're going to go into. But one thing that he mentioned about evaluating his performance is not evaluating it during peak times. Like if the overall stock market goes up 25% and he also goes up 25%, he doesn't consider that a very, very good achievement. While if this overall market goes down 40% and he only goes down 20%, he considers that to be a much better year. So it's a very interesting way of looking at investment performance. Now, let me go into Warren Buffett's investing strategy. So during this 12-year period, Warren Buffett had three main strategies that he used. The first one is investing in a category called generals. Now, generals are essentially what we would now call deep value investments. So he would go out and he would try to purchase companies with good earnings, who are growing their assets or where the assets are at least stable, and he wants to buy them for as cheaply as he possibly could. And oftentimes he would invest in companies where they were really cheap but they had very good earnings, or they might not have good earnings and maybe their earnings are declining, but they have a lot more assets versus how much liabilities they have. And this was the deep value investing period in Warren Buffett's history. He mentioned that he focuses both on how cheap a company is and the quality of the business, but he was focused a lot more at the time on how cheaply he could buy these businesses for. But it wasn't all just finding the cheapest company, and I find this is missed by a lot of people who study Warren Buffett. A lot of these companies that he bought for cheap, he would specifically look for companies where there was a dominant shareholder group that was going out and trying to initiate change in order for the value of that company to be realized, whether it being allocating capital to areas where they have a higher return, or it could be buying back shares, or just doing anything that was going to make it so that the value of the company was going to be realized, that it wasn't going to be cheap forever. And that's something that's very interesting to look at, because Warren Buffett did not want to get into a situation where he invests in a cheap company and they don't do anything about it, and even though he bought the company for cheap, it never goes back to the value that it should be. So another category that Buffett invested in was a category called workouts. And nowadays we call these arbitrage opportunities. These are essentially opportunities when a company goes through a corporate event. Let's just say they're going to be sold to another company. That's the most common one. Or there's going to be a merger, or there's going to be a spin-off. But most commonly, it's an example of, let's just say, company A, let's use a modern example. Let's just say Google decides to acquire Spotify, for example. And Spotify stock price, I have no idea what it is, but let's just say it's $35. Google goes out and says, okay, I'm going to acquire Spotify for $60 a share. And right after the announcement is made, the Spotify shares will go up to, let's just say, $50, say. Now, Warren Buffett will look at that situation and he will evaluate the likelihood of that deal going through. And if he thinks that the deal is pretty high, he's going to buy Spotify at $50 a share in the expectation that in a year or so when the deal closes, that the stock price is going to go from $50 to $60 a share, because that's the price that Google's going to acquire Spotify for. Now, Google Spotify, that's just an example. There's other examples that show instances where Buffett profited off these opportunities. And lastly, there's the control opportunities. Control opportunities are essentially when Buffett looks at one of his companies that he bought for cheap, and he decides that the management is not doing enough to realize the value of their business, that they're putting money into areas where they're not going to be making much profit, or they have a lot of unprofitable units in their business. And what Buffett will do in these situations is he'll first try to get the management to do something. But if the management isn't going to be doing anything, Warren Buffett will go and actually take over the business by acquiring enough shares so that he is the largest shareholder and the controlling shareholder. He would then go and fire management and then install a new CEO who will then execute his plan to realize the value of the investment that he made. And commonly what he would do is sell off the assets, deploy money into areas that are more profitable, or he would try to reduce costs and ultimately find a seller for that business after he's made those changes. He calls these control situations as insurance for his general investing opportunities, which is in case he invests in a company that's selling for cheap, and if nothing is done to correct the fact that the company's selling for cheap and the company's continuing to go down in a bad direction, Warren Buffett wants that extra insurance where he is able to then take control of that company in order to take matters into his own hands. So these are the three investing strategies. Warren Buffett will often put most of his money into the generals category. So he would put about 50 or 60% of his portfolio here. It will invest in anywhere around 5 or 10 stocks. His workouts, he would put about 20-25%. And control opportunities, he would often put anywhere from 20 or 25% as well. There's been cases where he would have one company in the control category to be as high as even 35-40%, which we're going to go over later. Now, let's go over some of Warren Buffett's investments. Now, this should be pretty interesting. The first example is an example of a general category investment. So this was the Commonwealth Trust Company. This was a bank that Warren Buffett thought probably should trade around $125, but it only traded for $50. And he did this by evaluating the earnings of the company. He found that the company had very stable earnings and will probably continue to be stable in the future. And he made that judgment because he understood the business of banks very well. Now, why was the business trading for low? Well, Buffett found out that the reason why people were undervaluing the business is that a lot of banks at the time paid out a dividend. And this bank didn't pay a dividend. And just for the sole reason that this company didn't pay a dividend, the company was trading for very cheap. And one interesting thing to note, in this situation, Buffett knew that there was a larger shareholder of this company who owned 25.5% of Commonwealth Trust Company, and that within 1 to 10 years, this larger company or this larger bank is very likely to actually acquire this company at some point. And he didn't know whether it be 1 or 10 years, but he figured it would be somewhere around that timeline, and the company would still continue to grow their assets and their value over time. So that while he's valuing the company at $125 per share, if the company gets acquired in 10 years, it would probably get acquired for about $250. So Warren Buffett goes and purchases the bank, and overall, after a few months or years, the stock price goes from $50 to $80, and because he found a better place to put his capital, he sold the company at $80. So, some very interesting facts here. We note that Buffett, of course, purchased a company that he understood at a very cheap price, but he bought this business knowing that at some point the value was going to be realized because of that larger shareholder that owned about 25.5% of this business was at some point going to take over the business. And he also didn't wait for the value to go from $50 to $125. He sold at $80. And this is reflective of another part of Buffett's philosophy, which is he will buy companies at such low prices that he doesn't need the stock price to go back all the way up to where he thinks the business should trade. Oftentimes he will sell the business sometime somewhere in between the price he bought and where he thinks the company's actually worth. And he'll do that if he thinks there's a better place to put his money. But this is a very interesting example. I would say this is a general investment, general style investment, maybe a little bit of on the arbitrage side. Another example of a business that he acquired is this company called Texas National Oil. So this is an example of an arbitrage or workout opportunity. So what happened in this situation is there was this oil company, Texas National Oil, and then this California oil company was going to acquire this Texas oil company. And Buffett read about it and then immediately, after doing his due diligence, invested in Texas National Oil because he saw that there was a very low chance that this deal was not going to come through. Now, whenever a merger acquisition opportunity happens, to evaluate how likely it's actually going to go through, you have to look at a few things. And Buffett realized that the deal was made with controlling shareholders. So the shareholders who own the most amount of stock already gave the okay. So there was very low chance of shareholders not wanting the deal to go through. He also saw that there was a very low chance that antitrust was going to be involved. In fact, everything seemed to go well for this deal, except some tax implications. But Buffett, after doing some due diligence here, realized that the tax implications were probably not that big of a deal, and he bought into this company. And then, of course, the acquisition ended up going through, and he ended up making a 20 or 23% return on this deal. So this is a basic example of an opportunity where there was the chance to invest in a merger acquisition opportunity and make some money once that company is acquired, because he evaluated that the deal was very unlikely to fail. Next, we want to go into Sanborn Map. Now, this is an extremely interesting case for a business. Sanborn Map was a mapping business. So back in the days before Google Maps, people actually had to draw and print their maps by hand. And these maps that Sanborn Map created were used for insurance companies. So Sanborn Map would go and make all these detailed maps of the cities within a specific region. And it would be useful for insurance companies to have the details of these specific cities, because these insurance companies, when they wrote premiums or when they underwrote any insurance, what they would do is they need to evaluate the likelihood of a fire happening, because these were fire insurance companies. And these maps help them figure out what kind of premiums they should charge the customer based on how likely a fire was going to happen. So that was the business. It was a very good business. They earned a lot of money from this business. But sometime around the 1950s, the insurance companies started to get a little bit suspicious of just how much money Sanborn Map was making. So they put in some insurance people onto the board of directors who didn't actually want the business to succeed very much. And also, there came about a different method of writing insurance that made it so that the profits that Sanborn Map was making was going to shrink considerably. So, around the time when Buffett purchased Sanborn Map, the earnings for Sanborn Map had gone from about $500,000 to less than $100,000 each year. And as you can imagine, investors were freaking out, and there was a lot of panic selling for this company. But Buffett realized something very interesting, which is the fact that in the 1930s or so, Sanborn Map had an investment portfolio that was worth about $20 per share. And around the time when Buffett purchased it, this investment portfolio was worth $65 per share. However, the company was only selling for $45 a share. So essentially, the value of the portfolio business, or the value of all their stocks that this Sanborn Map company invested in, is actually worth more than the company itself. And the value of the map business is being valued at negative $20 per share. That was how pessimistic all the other investors were. So Buffett, realizing this, decided to go and invest in this business. However, the problem with investing in this business is because the board of directors, a lot of them were insurance people, didn't actually want the value of this business to be realized. So in order to actually make money on this investment, Buffett had to continually purchase more and more and more of this company to the point where he was almost a controlling shareholder. And then he made a deal in order for the value of this business to be realized, where he made a deal with the shareholders that if they wanted to leave this company and exit the company, they could essentially give their shares back, and Buffett will pay them the value of the investment portfolio. And after this corporate event was done, it led to 50% of all the shareholders, 72% of all the shares, to essentially be bought back to the business. The business liquidated a significant portion of their investment portfolio, but because they got so many shares back, the earnings per share went up a lot. The dividends per share went up a lot, and the company ended up having a better asset allocation, and Buffett initiated a strategy to grow their earnings by digitizing a lot of the information that they had from these maps. So this is a very interesting opportunity where it was a cheaply valued business, but Buffett actually had to take matters into his own hands in order for the value of Sanborn Map to be realized, and he made a significant profit on this business. Another company that he did really well with was Dempster Mill. And this is another undervalued opportunity. So Buffett saw this business as a struggling business. The business was a company that sold farm equipment for farms as well as for water valves and things like that. And it was a manufacturer, and the industry was becoming extremely competitive for this business. So their profits were shrinking year after year. And the reason Buffett bought this business is because he saw that it had the book value, or it had more assets than liabilities. And if you subtracted the assets from the liabilities, there was about $75 per share to be realized. And Buffett purchased this business for $28 per share. And in purchasing this business, he did a deep dive on all of the different assets that this business had, and he valued them as if he valued them to the value that they would have if the business had to do a fire sale. So while he valued cash at 100%, something like inventory, he only valued at 60% of their total value, because he wanted to value it conservatively, as if he wanted to sell off all the parts of the business. So he valued the business's total net assets at about $35 per share in the event that he needed to initiate a sale of all the business's assets. So after that, what he also did was, because he realized that the management was not very competent and they would continuously allocate capital to or allocate money to areas of the business that wasn't generating significant profits, Buffett had enough, and he ended up taking over the business, firing the management. He installed somebody new to run the business. And that person, what he did was he sold off all the facilities that were unprofitable. He liquidated a significant amount of the inventory, cut a bunch of costs, and allocated capital from investing it into the business to instead buying stocks and getting a higher return from the money that way. So through this change, it caused the value of the business to eventually be realized. The business ended up being sold at some point for $80 per share once these changes were initiated, and Buffett more than doubled his money through this investment. Lastly, we got to talk about the most famous investment that he made during this period, which was actually in a company called Berkshire Hathaway. And this is one of the largest mistakes that Buffett has ever made, where this was a struggling textile business. Buffett invested in this business once he realized that the working capital was about $19 per share, and he purchased the company for about $14 or $15 per share. Now, working capital is essentially taking the total amount of cash that they have and subtracting it by the short-term assets. So essentially, this business was trading under the amount of cash that they had. But it was a struggling textile business. And when Buffett took over this business, he put a lot of time and effort into trying to revitalize the textile industry, but it didn't end up working out. And eventually, what he had to do was allocate a lot of the capital to other areas, such as banking or insurance, that he put under the Berkshire umbrella. But he really tried to revitalize the textile business, but the textile business never recovered. So even though Berkshire Hathaway ended up doing really well and today is probably one of the most valuable companies in the world, Buffett regrets buying this business because he believes that rather than putting all that money into that textile business, if he had just put that money into the banks and the insurance companies that he knew well, he would have made a lot more money today than he would if he put that money into the struggling textile businesses. So this is an example of what not to do when you buy cheap businesses. It's to stay away from value traps, to stay away from companies where even though the business is cheap, the earnings and the asset values are not going to be stable in the years to come. So the business would likely continue to be trading at a low valuation, and you'd never be able to realize the value of buying a cheap business. And Buffett was kind of able to weasel his way out of this by essentially taking control of the business and building up a banking and insurance company from scratch within Berkshire Hathaway. But for regular old investors like you and I who don't have hundreds of millions of dollars, this is an example of something that we should learn from, and we should not repeat this mistake that Buffett made. So what is there to learn about how to achieve great returns based on what we learned from Warren Buffett and how he invests in his early years? Well, the first thing is Buffett made a lot of money by investing in small cap companies. He would focus on areas that weren't noticed, small companies where there were a lot of inefficiencies, and he was searching primarily for deep value, where he could get companies that had high earnings or companies that had a lot higher assets versus how much they were trading for. And he purchased these companies also with the intention that either somebody else would do something or he might do something in order for the value of that company to be realized. He always wanted there to be a dominant shareholder in management who was going to do something to revitalize the business, whether it be to sell off unprofitable units or to grow their assets, or to find ways to grow their earnings, or to deploy capital into areas that had higher returns, and to phase out parts of the business that wasn't doing well. But if he saw that the management was incapable of doing that, Buffett would always be that person to come and initiate the change himself. Now, for regular folks like you and I, we should always try, if we're going to be following the strategy that Buffett did, to make sure that there's going to be an outside group that is capable of helping the value of our investments be realized, and that's really important. In all these deep value investments, Buffett always focused on areas that he understood very well, that he believed there was going to be a high chance of his investment working out. And the way he invested was he always looked for bets that he could be fairly certain about. And the last thing is to avoid value traps. And Berkshire Hathaway, even though it's a very well-known company, probably the most valuable company right now, it wasn't the best investment that Buffett made. And as investors, if we're going to be duplicating this strategy, we need to avoid businesses that are in such a decline that in the future they might not be able to continue to maintain their earnings, or to grow their earnings, or to grow their assets. And we need to avoid companies that aren't able to achieve stable earnings or stable asset values in the future, because even if we buy them for cheap, they might continue to trade lower, and we might never be able to realize the value of our investment. So thank you so much. Hope you guys enjoy this breakdown of how Buffett invested in the early days. I hope I gave some lessons for you guys to think about, and hope you guys tune in to the next one. Thank you so much. I'm going to see you all later. Thank you.